it's easy to just go leveraged. And for significant portions of the year of the investment cycle, it's not a bad idea, but that's not what we're trying to do.
All right, joining me will be Roxanna Islam, Head of Sector and Industry Research at VettaFi. And boy, I'll tell you, there were a number of noteworthy stories in the ETF space last week, including Goldman Sachs acquiring Innovator ETFs in a $2 billion deal, by the way, $2 billion, a monster number. We also saw Vanguard finally opening up brokerage access to spot crypto ETFs nearly 2 years after the first spot Bitcoin ETFs launched. Let's see, we had the SEC pretty strongly pushing back on these filings for 5 times leveraged ETFs. There were a number of big stories. And so Roxanna and I are going to bat these around a little bit. And we have a few other ones to get to as well. Should be a lot of fun. I'll then be joined by Petra Bakosova, CEO of Hull Tactical and portfolio manager of the Hull Tactical U.S. ETF, ticker HTUS, which this offers tactical risk managed exposure to the S&P 500. And I thought this would be a very timely ETF and certainly a very timely topic to cover, given that some of the recurring themes in the markets right now are these investor concerns around stock valuations and the top heaviness of the S&P 500. And I would describe the problem like this. If you're an investor or you're a financial advisor, obviously having exposure to the S&P 500 has been highly beneficial. And so the question is, how do you maintain that exposure? Because the S&P 500, it could keep charging ahead, just like it has been. So how do you maintain that exposure, but perhaps better manage some of the potential risks that are out there, and also do so without bringing emotions into play, right? Which is always easier said than done. And I think what Hull Tactical is attempting to do here with this ETF is just that. And so Petra will explain exactly how they're trying to solve this challenge, and we'll get into how the ETF itself is currently positioned and what that might be telling us about the markets. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. Okay, so let's start this week with VettaFi's Roxanna Islam. Roxanna, thank you for joining me. Anything at all happen in the ETF world last week?
Hey, Nate, great to be here. Well, a few interesting things did happen. As usual, there's always a ton going on in the ETF world.
Well, this won't surprise you, but I thought let's start with Vanguard opening up their brokerage platform to spot crypto ETFs, which again, this took nearly 2 years to happen, because I'm sure you remember Vanguard came out immediately after the launch of spot Bitcoin ETFs in early January of 2024. And they said they weren't going to allow spot crypto ETF trading on their platform. But here we are 2 years later, and they have finally capitulated, which, by the way, I'm not shocked in the least. I predicted this, which we can talk about that if you'd like, if you want me to do a little victory lap here. But first, give us your take on Vanguard reversing course.
Right. I mean, and this is big news for crypto, specifically crypto ETFs. I mean, as you said, Vanguard has actually been pretty vocal against offering crypto ETFs on their platform. So, this is pretty big news. They're not a small brokerage platform at all, obviously. They're one of the largest, 50 million customers. Even if a portion of those, start exploring crypto ETFs, that could be some significant inflows. So it's pretty exciting news for the industry. And it's interesting because they actually posted, an article on their site that talked a little bit about this. And I thought it had some really interesting tidbits because they made some points that, I would say are actually positive points for the industry. They talked about how the industry has matured and how we've seen these products move through market cycles and that they've behaved as they were designed to. They also talked about some of the administrative processes maturing and investor preferences evolving. So I would say, a lot of this sounds, pretty positive to me. They did sort of clarify that they aren't interested in, releasing their own products. They're going to focus on products that generate, stable cash flows like interest and dividend payments. So they're not going that direction, but it's still, pretty big news. And I don't know if you saw the news about I'm sure you did, about Bank of America. They also started saying that their advisors could offer start recommending 1 to 4% crypto allocation starting in January. So when both of these news items came out, I actually saw the price of Bitcoin pop about 5% upward. So it seems like the industry really likes this news. It seems like we are seeing a lot of sort of long-term tailwinds, even though we are in this massive price pullback right now.
I did see the Bank of America news, and I know I've been a broken record on this overall, but I think it's important to point out that spot Bitcoin ETFs have put up these record numbers. They've broken just about every industry launch record over the past couple of years, and they did so, as I've said, with one hand tied behind their back, because they didn't have access to, say, Bank of America or Vanguard or some of these other major platforms. And to me, that's just mind-boggling. And we know, new ETFs, they always face some challenges with distributions, but it felt like those challenges or those hurdles were even higher for spot Bitcoin ETF. So I have to say that going back to Vanguard, I did read the blog that you mentioned, and maybe I read that a little bit more negatively. Vanguard was clear. They're obviously not endorsing spot crypto ETFs in any way, but I thought they actually took a little bit of a jab at crypto, because they said that they focus on products that generate cash flow in a transparent way, right? Investments that have things like interest payments and dividend payments. And so I thought, they were basically saying, hey, look, that's not crypto. And to your point, they also said they have no plans to launch spot crypto ETFs. But, they are allowing clients to trade these now. And I guess my take, Roxanna, is just when they first gated access, again in January 2024, I just felt like they would be alienating their own clients by playing the role of nanny. I said I felt like there were plenty of people, including me, by the way, who appreciate Vanguard's low-cost stock and bond funds, but they want to sprinkle in a little bit of crypto. And it just seemed like Vanguard, playing the role of nanny was a bad look. I think especially to younger investors who view crypto as a pretty normal part of their allocation. So that part never made sense to me. And then the other thing that I said was that I felt like Vanguard's position would only grow more problematic as additional spot crypto ETFs came to market. And I think, we've seen that recently. And actually, we can talk about that in a minute. I want to ask you about some of the spot crypto ETFs coming to market. But my thought there is that would continue to put pressure on Vanguard, because we have spot XRP and spot Solana. All these products are coming to market. You can't buy them on Vanguard, and they're doing pretty well overall in terms of investor demand. And then you look at Vanguard's competition, the Schwabs and Fidelities of the world. Those platforms aren't telling their clients what they can and cannot buy. So I just thought that was a tough spot for Vanguard to be in. And, that certainly ratcheted up the pressure. Plus, your biggest direct competitor in BlackRock, they actually offer some of these products, right? Spot Bitcoin and spot Ether ETFs. And so here you are saying we're not even going to allow our clients to trade them on their brokerage platform when your largest competitor directly in the fund space is offering them. I just thought it was a bad look all the way around, and I called it an untenable position. I just didn't see how they could stick with this, and clearly they agreed with that. I don't know if you have any follow-up thoughts to my rant there.
No, it's no. You definitely make some good points. I think it was only a matter of time before some of these larger institutional players that were against it gave in, and I think it does kind of put them at a disadvantage versus those players that were early to the game.
All right, so clients can now access that on Vanguard's platform. While we're talking crypto, I just mentioned all of these spot crypto ETFs that have come to market recently. And let me rattle off at least the ones that I see. So these are over about the past month or so. We've had, as I mentioned, spot Solana ETFs. Those are from Bitwise, Grayscale, Fidelity, 21 Shares, VanEck, Canary. And then spot XRP ETFs from Bitwise, Grayscale, Canary, and Franklin Templeton. And then we saw Grayscale and Bitwise both launch Dogecoin ETFs. Last week, Grayscale also launched a Chainlink ETF. I know a few weeks ago, Canary launched the HBAR ETF. I'm sure I'm missing something here. And by the way, I should note, these are all 1933 Act ETFs. We should acknowledge that Rex Osprey did have 1940 Act Solana, XRP, and Dogecoin ETFs already on the market. But I guess my question for you is, what's been your initial impressions on investor demand for, I guess, all of these?
Yeah, I mean, I think investor demand has actually been relatively strong, especially when you consider the market that we're in and some of the price pullbacks that we've seen. I do think that, a lot of the demand is focused more on the Solana and the XRP products. I think those are the products that a lot of advisors and investors are a little bit more familiar with, because we have seen, these filings in the pipeline for a while. Their narratives are a little bit more simpler to understand than some of these other smaller cryptocurrencies. But granted, like you said, it's been, maybe about a month since some of these have launched. So there's not a lot of history to look at. But I do think, if you look at the demand for Bitwise's BSOL, for instance, it's had over 800 million net inflows since its launch in late October. I mean, that's pretty good. Considering if you bought that when it first launched, you would be down around 30% because of the price pullback. It's a little bit interesting. Tale of two stories, where you have these pricing drops, but then you also have investors that are a little bit curious about these products. If you look at XRP, I think it's a similar story. A lot of these products have, a couple hundred million in net inflows, and it's actually a little bit more spread out. So Canary's XRP ETF has about, a little over 350 million. Grayscale's has a couple hundred. Bitwise, Franklin, they all have, about a couple 100 million. So a little bit interesting to see that more spread out there and not, as top heavy as, the Solana products. What I do think is interesting is, as you rattled off the amount of products, is the amount of issuers that are getting into the single asset crypto space. I think it's a very exciting space, but obviously, there's a lot of competition within it. And I think, that's where it gets interesting. I mean, it makes it difficult, I think, from a due diligence perspective, but I think it also, makes it difficult from an issuer perspective when you're trying to compete for margins. So, an interesting thing that I saw recently was that, CoinShares, they actually pulled some of their plans for the single asset products. And they said they were going to pivot and focus a little bit more on, some of the crypto equity products and some of the other active crypto strategies. So it's, the field is already getting a little bit crowded here with the number of single asset ETFs. If you look at the number of crypto ETFs that were launched this year, and this isn't all single asset, but, we've had about 75 of these crypto ETFs launched this year. So it's the field is getting crowded, and we're starting to see some interesting things happen, among the issuers right now.
Well, and to that point, just on the competitive dynamics, I think the other aspect here too is the fees on these products, I think, are much lower than what a lot of issuers originally thought they might be. We know the story with spot Bitcoin and spot Ether ETFs. It's amazing how low those products came to market on the expense ratio side. But even if you look at the spot SOL and spot XRP ETFs, I mean, you're talking highly competitive fees. And exactly with what you were saying, there's a lot of issuers in this space. So very competitive. A couple other points that I'll make, Roxanna, to what you were saying. I was looking at the total assets in spot Solana and spot XRP ETFs this morning. And what I thought was funny, so on spot SOL ETFs, if you include the Rex Osprey product, which offers spot SOL exposure, you have about $1.3, $1.4 billion across those products. And then on spot XRP, again, if you include the Rex Osprey XRP ETF, you have over $1 billion in those products. And what I thought was funny is I remembered back to spot Bitcoin ETFs when you had a lot of prognosticators that thought those wouldn't even have $1 billion total in them, and now here we are a couple of years later, and you have these other, altcoins coming to market that pretty easily are surpassing $1 billion in total assets. The other thing that I'll mention here, and maybe this gets into us talking about crypto index ETFs, which I want to ask you about, is I keep saying I think the demand for all of these altcoin products is going to look very similar to what the underlying market caps are of the coins themselves. And so the example I keep using, let's take XRP. if XRP's market cap is 15 times less than Bitcoin, I would expect XRP ETFs to have 15 times less demand, if that makes sense. Like I think the demand for the ETFs will be reflective of the underlying market caps. And so as you start going down the market cap spectrum, like if you look at the Grayscale Chainlink ETF, which has done great for how long it's been out, it has like 50 million in it. The Canary HBAR ETF has something like 85 million in it. I think that's what we're going to see. And the other piece of that too is like if you look at the spot Dogecoin ETFs, those haven't had much demand, and that doesn't surprise me because I think that that's clearly a meme coin. I don't think financial advisors necessarily want to allocate to that, and I think a lot of people who may allocate to Dogecoin, they're playing directly in the crypto space. Like I just don't know that they're going to get exposure there. But my point being, I think something like Dogecoin would be an outlier from my little market cap formula. But all of that said, I think what this leads us to is crypto index ETFs, right? Because I don't know that advisors do want to be in the business of trying to figure out, should I buy a Chainlink ETF or an HBAR ETF or whatever? And so they're just going to spread their bets. And so right now we have spot crypto index ETFs from Hashdex, Franklin, Grayscale, 21 shares. I don't know if you saw this morning, Bitwise uplisted BITW. CoinShares, who you mentioned earlier, they have one that's comprised of other spot crypto ETFs. But do you have any thoughts on those and maybe how those are faring thus far?
Yeah, I mean, I like the idea of these crypto index ETFs. I think they're very advisor friendly. They're very analyst friendly. They come with that much needed diversification that we all talk about in the crypto space. Demand wise, I would say the demand there is still small but growing. If you look at the Hashdex products, which came out earlier this year, it has last I checked, about 120 million year to date. So it's there, but growing. I think the industry hasn't quite matured yet to the point where a lot of advisors are looking for these diversified crypto index ETFs. I think soon we'll be there. I think people are just now starting to understand the Bitcoin story. So they're still trying to wrap their heads around it. And I think, especially when you're looking at some of these self-directed retail investors, they get really excited about the single asset products, right? They like making a call. They like, trying to pick a winner. So we're sort of seeing this divergence, between behaviors. And I think we're going to see a lot more of that middle ground, as the industry matures. We're going to see a lot of people, try to look more towards these diversified crypto ETFs, which, by the way, if you look at, most of these, you'd see that Bitcoin is actually a large portion of all of these, maybe 75 to 90%, depending on which product you're looking at. So you basically are getting a lot of Bitcoin. You're just getting, a little bit of taste of a few other altcoins without having to, pick and choose yourself.
Yeah, I think, as you know, highly bullish on crypto index ETFs longer term. I think what has happened here, because you're right, the demand initially it's been okay, but nothing spectacular. I think a lot of financial advisors in particular who wanted crypto exposure, they jumped in to the spot Bitcoin ETFs, right? And so they already had that allocation. What I think is interesting is we know that Bitcoin has pulled back fairly substantially over the past couple of months. I wonder if you see some tax loss harvesting to where advisors will sell out of their spot Bitcoin ETFs, maybe if they have a little bit of a loss, and then they move into the crypto index ETFs. But even putting that aside, I think longer term, you're going to see pretty significant demand for those. I wouldn't be surprised if that category actually becomes the second biggest crypto ETF category besides Bitcoin ETFs, but we'll see. Okay, enough crypto talk for today. Let's move on and talk about another big story last week, which was the SEC, I would say, fairly strongly pushing back against these 5 times leveraged ETF filings. So I think there were 9 ETF issuers involved here. And I don't think all of them were pursuing 5 times leverage, but certainly 3 times leverage or more. And my sense is, I think these issuers thought they might be able to get these through what's being perceived as a much more lenient SEC. But clearly the SEC is not having it. What did you think about them pushing back on those filings?
Yeah, I mean, it was an interesting story, like you said. I have to admit, in the back of my head, I wasn't sure if these were going to get approved because, like you said, we're always hearing this is a new SEC, this is a new era. But overall, I didn't expect these, to get approved. I'll say that I do like leveraged ETFs. I think they're fun. They can be cool trading tools. They're also interesting from an analyst perspective because they tell us a lot about investor demand. So I love following them. I love tracking them. I don't know if anyone needs a 5 times ETF. It's a little bit, it's a little bit much, especially since now we don't have really anything above a 2 times. We have some 3 times. They are mostly index products. They were grandfathered in, before the SEC started their implemented their rule, the 18F4 rule. But 5 times is a lot for anyone. So I think, I'm not surprised that the SEC pushed back on some of these filings.
Well, it's just the math of these products, right? Like if you think about the 2 times leverage strategy ETFs, for example, MSTX, the defines 2 times long MSTAR ETF, that thing is down like 90% plus over the past year. 90%. Now, imagine if it was 3 times or 4 times or 5 times leverage. This thing would have easily blown up by now. It's just too much juice. And so that it makes sense to me. I think if you cross over, I'm sure there's a threshold here, but you start getting north of 3 times. Again, it's just math. It's not unusual to have some of these highly volatile stocks move 30% in a trading session. I'm not saying it happens every day, but it's not a rare occurrence. So it makes sense to me that they push back on those. It'll be interesting to see if issuers try to get creative and somehow come back to the SEC and bring these to market. I don't have an issue with leverage ETFs existing. I've talked about that for a long time. I do feel like, again, 4 or 5 times, that just seems like a little much. Okay, 2 other stories I want to ask you about. First, this one definitely caught my attention. It's one I mentioned at the top, which is that Goldman Sachs will be acquiring Innovator ETFs for $2 billion. $2 billion, which congratulations to Bruce Bond and the Innovator team. I've actually had Bruce on here several times, so I'm very happy for him. He, essentially pioneered the defined outcome ETF space. So he can now go buy an island because of this deal, I think. But from Goldman's perspective, this immediately makes them the leader in defined outcome ETFs, I believe. I know First Trust is right there, but Innovator has some $30 billion in assets. Did you like this deal for Goldman?
Yeah, I think it's big news for Goldman. I mean, Innovator, as you said, it was the original name in these defined outcome ETFs. Goldman's gonna, get Innovator's 28 billion of assets under supervision. They have 150 plus ETFs in this space. It's a really fast growing space within the ETF industry. A lot of people don't know that it just started recently in 2018. So the space itself is only around 7 years old. I saw some Bloomberg data the other day showing that it grew from 5 billion to about 75 billion over the past 5 years. I know Goldman cited a Cerulli report saying that, the space could grow 4 to 5 times over the next 5 years. So, it seems like, growth, is not going to really slow down anytime soon. And as you said, I think, this is a very easy and efficient way for Goldman to grow its name in the space. So Goldman did have, some large cap buffer ETFs, relatively small in relation to the rest of the industry. So I think this is a very easy way to enter, what's a crowded space as more issuers sort of start looking and start trying to grow their products within the defined outcome.
I agree with all of that. I think the only thing that gives me pause, which doesn't impact investors, is just the price tag on this deal, the $2 billion. Because I immediately thought back to an interview that I literally just did on here with Aptus founder JD Gardner. And I'm not sure if you listened to that, but Aptus recently rolled out their own suite of buffer ETFs with expense ratios of 25 basis points. And if you look at Innovator's average expense ratio, I believe it's somewhere close to 80 basis points. It's right around there. But in visiting with JD, he basically said that these buffer ETFs are pretty simple to run, especially if you have the options expertise in-house, as Aptus does. And so his point was you don't have a bunch of other hands in the pot that you have to pay to run these things, and that helps keep fees down. And so I think I just thought, the buffer ETF category as a whole is probably going to see significant fee compression. I know BlackRock, they have some buffer ETFs at 50 basis points, and we know how aggressive they can be when it comes to competing on fees. Again, I guess just from a pure valuation perspective, $2 billion for Innovator, it seems like an astronomical number, given that I do think fees will come down in this space. Now, I will say, on the other hand, because I like to think about the full picture here, I also get that Goldman Sachs has significant distribution. And we always talk about how distribution is king in the ETF space. And perhaps Goldman's clients aren't as fee sensitive if their wealth managers are putting these ETFs into portfolios, which I'm sure was part of their strategy here. So I don't know if you have any thoughts on that. I mean, we're not privy to all of the underlying factors of this deal, but in the ETF space historically, we do see fee compression, and I don't know why it would be any different here.
Yeah, I mean, I don't disagree there. I think we could start seeing some of those fees come down, especially as we start having some of these new competitors come in with lower fees. So I don't disagree with you. I do think, Goldman did see value behind this deal, even though, $2 billion is a pretty hefty price tag. I think they saw value behind the brand of Innovator, since they are, one of the big names. They are the original name within the space. So I think, that sort of contributed a bit to that price tag that they had.
Yep, build it or buy it. Goldman is buying it. All right, the last story I have for you. This one's a little bit technical, but I do think this has real investor impact, and that's Invesco attempting to convert the QQQ trust from a unit investment trust into an open-end fund, which in a nutshell, that will allow them to keep a lot more of the fee revenue from this ETF instead of having to spend it on marketing, right? Which is why you see QQQ ads everywhere. We can get into that if you want. But for investors, the fee on this ETF would drop from 20 basis points to 18 basis points. And then the fund would be able to do things like reinvest dividends and securities lending, those sorts of things that they can't do as a UIT. But here's the thing, Invesco needs shareholders to approve this. And as of last Friday, they still don't have enough votes. Any color you would offer on that?
Yeah, I mean, it's an interesting story because I've actually seen a couple of news articles about there that were a little bit entertaining because they were commenting on the number of calls and emails and mail outs that Invesco was doing just to get people to vote. But I mean, logistically, it is, difficult because they do have a lot of shareholders. It is, difficult to get all those people to vote. Last I saw, they had about 50% of the votes, and I do think they need around 51%. And as far as I understand it, they can keep going until they get the amount of votes needed. Overall, it great for investors. They'll see that expense ratio drop a couple basis points. And it shouldn't really affect anything regarding performance or operating in terms of investors. So, I do see this passing. I do think investors will benefit from the lower fee. But, it's sort of interesting because, UIT is, a little bit more outdated of a structure than an ETF, a little bit less investor friendly. So it sort of goes with that shift that we're seeing, a lot of the mutual funds converting to ETFs. It sort of falls along, that story where you see, these issuers start shifting more assets more towards the ETF side.
By the way, I can tell you firsthand how aggressive Invesco has been in reaching out to shareholders of QQQ, because as you know, I run an investment advisory firm and we have some clients that actually own this. And to hear the clients describe this, Invesco has been absolutely war dialing them. I mean, to the point where seriously, our clients were alarmed, like they thought something was wrong with the ETF itself. Of course, that's on us to make sure we educate them as to what's going on in the process. But Invesco has been extremely aggressive in reaching out, which I get, right? This is a lot more revenue they keep in house, but to what you were saying or what I was saying, there's also some investor benefits here as well. And so I think you have it right. as I understand it, they had this vote. They're just short. They need 51%. And so they don't actually have to go and redo the full vote. They adjourned the voting session. And I think they pushed the deadline out to December 19th. And so I'm assuming people will continue to get more calls from Invesco if they own this. But interesting story nonetheless. Roxanna, great stuff this week. I always say never a dull moment in ETF land. Thank you for joining me.
Thanks, Nate.
That was Roxanna Islam, Head of Sector and Industry Research at VettaFi.
When it comes to active fixed income, AllianceBernstein leads the way. With AB's systematic fixed income ETFs, the AB Core Plus Bond ETF ticker CPLS, and the AB Corporate Bond ETF ticker EYEG, advisors gain access to Core Plus and investment-grade bond exposure backed by cutting-edge proprietary technology. These ETFs combine deep research with risk-aware strategies to help you navigate today's markets confidently. If you're ready to enhance your bond allocations with solutions built for the future, explore CPLS and EYEG from AB. Visit abfunds.com/go/ETFs to learn more. Investing in securities involves risk and there is no guarantee of principal. Investors should consider the investment objectives, risks, charges, and expenses of the fund/portfolio carefully before investing. For copies of our prospectus or summary prospectus, which contain this and other information, visit us online at www.alliancebernstein.com or contact your AB representative. Please read the prospectus and/or summary prospectus carefully before investing. CPLS and EYEG, distributed by Foresight Fund Services, LLC. Foresight is not affiliated with AB. Markets are always evolving. The Hull Tactical U.S. ETF HTUS uses quantitative models to tactically adjust exposure to U.S. equities on a daily basis. It's about adapting with discipline. Learn more about HTUS and how it can complement your investments at hulltacticalfunds.com. Carefully consider the fund's investment objectives, risk factors, charges, and expenses before investing. This and additional information can be found in the fund's prospectus, which can be obtained by visiting hulltacticalfunds.com. Read the prospectus carefully before investing. The fund is distributed by Northern Lights Distributors, LLC.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
I'm now joined by Petra Bakosova, CEO of Hull Tactical and portfolio manager of the Hull Tactical U.S. ETF, ticker symbol HTUS, which this offers tactical risk managed exposure to the S&P 500, as we will certainly get into. It currently has about $140 million in assets under management, and Petra is joining me from Chicago. Petra, it is a pleasure. Welcome to the podcast.
Thanks for having me, Nate. I'm very excited to be here and talk about HTUS.
Okay, so I have to tell you, I always love a good ETF backstory. And so I thought, let's start with Hull Tactical, the firm itself. I'd like to have you tell us more about that. And then give us the story behind how HTUS actually came to be.
Sounds good. So HTAA was founded as a company in 2013 and the fund launched in 2015. However, to understand our story and our investment philosophy, we have to go way back. We have to go back to 1971 to blackjack stables in Las Vegas, where our founder Blair Hull started his what he calls investment career as a blackjack card counter. So he was on one of the original teams that later inspired the movie 21 and Beat the Dealer, the book. And so through playing 60 hands an hour for 8 hours at a time, for 2 days, for 52 weeks, for 5 years in a row, if you were doing the math in the background, I think that adds up to something like 200,000 hands of blackjack. He realized in order to be successful as an investor, there are 3 rules that he instilled in all of us. One is bet often. Second is bet proportional to your advantage. And number 3 is stay in the game. So, a couple little investment projects later, and I'm being a little sarcastic when I say little investment projects because most people in the industry are very familiar with Hull Trading, which was a company he founded and later sold to Goldman Sachs. we ended up at Hull Tactical sort of implementing these 3 core investment tenets inside an ETF.
Okay, this is a much more exciting backstory than I could have imagined. And I have to tell you, I've been known to play a few blackjack hands from time to time, though. I probably could have used his tips. I don't know that I fared quite as well as he did. Okay, so with the whole Tactical U.S. ETF itself, I have a number of questions on this, but I guess first take us through exactly what's going on inside this ETF. Take us through the specific investment approach.
Sounds good. So basically, our investment approach, as I mentioned, is a little unique inside the ETF ecosystem. A lot of ETFs, when they originally started, were kind of passive mechanical funds that picked some kind of a basket of stocks and stuck to the basket for a quarter or a year. That being said, we wanted to be a little bit different. And what we wanted to do, we wanted to track all publicly available information, or at least all relevant publicly available information about the economy, the market, the sentiment of the market, and make informed decisions about how invested investors should be in the S&P 500. I think it's a well-accepted premise that most investors should have some exposure to the S&P 500. But what we're challenging is the notion that this exposure should be fixed and that the exposure should never change. So what we're saying is there's a lot of information available out there, and over the years we have developed these tremendously powerful predictive analytics tools that we use everywhere else in our lives, except maybe in our investment portfolio. So what we try to do is take these sophisticated machine learning and statistical algorithms and try to distill the publicly available information and give people some opinion about, should you be a little more than 100% invested in the market? Should you be slightly less than 100% invested in the market? And then hopefully over the entire market cycle, that enhances investors' risk-adjusted returns.
Yeah, and to your last point, I think you said that well. My understanding is the goal here is to outperform the S&P 500, but with a very important, I'll call it caveat, you want to do so without excess volatility, correct?
Correct. So we're trying not to, exceed. It's easy to just go leveraged, and for significant portions of the year of the investment cycle, it's not a bad idea. But that's not what we're trying to do. We're trying to, not exceed the volatility of the S&P 500 and create some excess returns.
And my understanding, the actual exposure to the S&P 500, you can obtain that through S&P 500 ETFs, futures, options. I think also, depending upon the market environment, you may see VIX futures in this ETF. I know that if you're not fully invested, you can park in short-term U.S. Treasuries and other cash instruments. I believe right now, if I go look at holdings, you currently have BOX, BOXX. I guess talk more about how your underlying model decides when to dial risk up or down. Like give us some more detail here.
Sure. So the underlying investment model is a very multidimensional model, if you think. So I already mentioned we look a wide variety of indicators. That would be anything from economic data, you think inflation, unemployment, things of that nature, fundamental data. We look at individual components of the S&P 500, aggregate them to the top. We look at their earnings yields, dividends yields, book-to-price ratios. We look at market sentiment measured through, realized volatility versus VIX versus investor sentiment versus, professional surveys. And we look at technical indicators as well. We're not underestimating the power of momentum and mean reversion and things of that nature. And so that's kind of like what goes into the models. And then it's an ensemble of a number of models that look at different horizons going forward and look at different lookbacks going backwards. So, we want to form an opinion about, what is the market going to do over the next day, but also we want to know what is the market going to do over the next week or over the next month. And so we are very multidimensional in terms of the information we process, but also the outlooks that we try to capture.
If we just take a step back and look at this ETF from a much higher level, I'm curious, what problem do you see HTUS solving for investors and financial advisors? Because obviously you view this ETF as a solution in the marketplace. So what's the problem?
Absolutely. I think every financial advisor will agree with us that, generally speaking, one of their hardest part of their job is just to get their clients to stick with the plan. All humans, including two of us, are emotional creatures, and we get scared. And it's not easy to stick to the plan when we're bombarded by the news about, this going on and inflation going up and economy losing jobs and, AI stealing everybody's jobs and things of that nature. And at the same time, we all agree that, generally speaking, or at least historically, it has been a really good idea to be invested in the market. So what we're proposing is a solution. We're trying to give advisors a tool that allow them to, on average, be invested in the market, but also allows them to not ignore everything that's going on in the world. And so we're giving them a tool that will give the core market exposure to their client, but also will be able to respond if something happens. And we'll be able to answer questions about, okay, so is the inflation really bad? Are the valuations extreme? So we're trying to give a smarter core replacement product to clients.
Out of curiosity, I was looking at your background, just given your quant background and then the underlying investment approach that you're describing here. Did you ever consider packaging this strategy into, say, a hedge fund format, or was the ETF wrapper always the vehicle of choice?
This was one of the first discussions I encountered when I started with Hull Tactical. I was hired in 2014 as a quant. And, I was sort of like a fly on the wall in the initial discussions before the fund launched, but I remember them vividly. And there was definitely like a segment of the population that thought like, oh, this is going to be so hard to launch as an ETF. At least, 10 years ago, it was kind of unusual to be an active fund and kind of a quantitative fund. There were a lot of unanswered questions about like how we were going to able to get the execution, how we were able to keep the spreads tight and things of that nature. But on the other hand, there were two really important reasons why we decided to stick with the ETF plan. One was we wanted to democratize the access to quantitative research to retail. We always felt, the people like Blair, our founders, they have the ability to hire a group of quants. They have access to hedge funds and they have access to sophisticated strategies. But the average retail client does not have access to any kind of advanced research and doesn't have access to sophisticated strategies. And when we just felt, that was not fair. And we were going to give them the same kind of research that traditionally would not be offered in an ETF wrapper. And the second reason, a little more academic or abstract, what we're doing is market timing. Let's not beat around the bush. And market timing has been a very controversial topic in the investment industry as well as in academia. And we thought the ETF is the perfect wrapper if you're trying to be very transparent about what you're doing and about your track record. So there's no hiding your positions. There's no hiding your daily returns. And we thought, we're just going to accumulate data points and contribute to the discussion about, is this possible? How much can this benefit somebody's portfolio? So the second reason was a little more altruistic, just trying to contribute to the discussion about the relevance of market timing and the possibility of market timing.
Well, let's talk more about that last point, because I think you're right. I think market timing certainly has generated a lot of debate, and we do have a transparent ETF wrapper here where people can go look at the track record. Let's talk a little bit about performance. And I'm not sure how detailed you can get here. I'm always sensitive to compliance considerations. So I realize there's only so much you can talk about here. But what can you tell us about how HTUS has performed across different market regimes, and what should investors and financial advisors expect from a performance standpoint longer term?
Absolutely. So obviously nothing that has happened in the past is ever going to happen in the future. And anything that I will be discussing over the next 10 seconds can be taken as me making any promises about what's going to happen. But what we have seen in the last 10 years of running this fund, generally speaking, and this is going to be kind of not surprising to anybody, it's hard to time the market when the market just goes up with no volatility. So that's where we sort of saw kind of like a little bit of struggle for the fund when we saw big rallies without any excess volatility. On the other hand, we have seen the fund perform better when the market was kind of going sideways or maybe a little bit down. So 2022, for example, was a good year for the fund, which was a big pain point for a lot of advisors and their clients. And so if you look at the track record, we are underperforming a little bit on a 1-year horizon, about even on 2 years, exceeding 3 and 5. We're lagging a little bit since inception. So it's kind of a mixed bag, but it's kind of in line with expectations, what you would expect from a market timing strategy. You would expect to add more value in volatile markets. You would expect to add more value in flat or bearish markets. And then you're trying not to give up too much of the return in the bull markets and hope everything like adds up over time.
Related to performance, something that Petra is always a topic on ETF Prime is fees. And in looking at HTUS, the expense ratio on this is 91 basis points, I believe, which I would say is on the higher side. If we just look at the average fees, say for active ETFs overall, why do you think that fee is justified?
It's a good question. And honestly, I've been getting this question a lot less in the last couple of years. I think over the 10 years, we have seen, and I would say in the last 3 years, maybe, there has been a lot more demand for active funds and funds that include derivatives and options. And as those have been becoming more popular, they do generally come with higher price tags. So I would say in the peer group of active funds, which include derivatives positions, we're probably pretty much in a range. We are expensive compared to a passive mechanical large cap fund. And the reason why we think this is justified is, one, I think the performance has been good. And two, what people are paying for, what clients are paying for is the institutional grade research that, traditionally would not be offered in an ETF wrapper, that would traditionally have some kind of a management plus performance fee in a hedge fund wrapper. And they're paying for the research we have done, but they're also paying for the research we continue to do in the future. So we're not done improving the strategy. We intend to, discover more indicators, more models, evolve the fund as we go. So I think that's part of the price tag.
Okay, so we've talked about the strategy underpinning HTUS. You've touched on performance fees. Let's come back to how investors and advisors should think about this ETF in the context of a portfolio. How do you like to describe where this ETF fits?
So we touched on it a little bit earlier when I said I think of it as a replacement for S&P 500, like a smart core. And I think that's the natural place to start for most advisors and most clients is, take a little bit of your passive S&P 500 position and turn it into an HTUS position, which would over the long term behave, somewhat correlated or fairly highly correlated with the S&P 500, but hopefully with a little added edge. And we also see it being used by clients who are interested in alternative alpha generating strategies. So, some advisors might have clients who have a core market exposure and then try to get some kind of a hedge fund, alternative quant exposure, and HTUS can be a good combination for both. So that's another use case for the fund. The one, I would say, warning, if you will, we always give to clients is because we are an active fund and we have to pay most of our gains as dividends every year. The big difference between a passive S&P 500 fund and HTUS will be HTUS is much more suited to a tax sheltered account. There will be, significant dividends. So definitely we advise people to stick it in their RIAs or any kind of tax sheltered accounts if they can.
Okay, with our remaining time, let's talk a little bit more about how this ETF is positioned and maybe just what you're seeing out of the various indicators, which, by the way, as I was looking at the materials on the website, I saw references to micro alphas. Are those the indicators that you're using to sort of arrive at the daily market exposure?
Exactly. So the micro alphas, as we dub them, are all the different indicators that we look at. And the reason why we call them micro alphas, we think they're all individually generating alpha for the fund, but individually they would be too weak to really beat the market as a standalone strategies. And I think that's partially, going back and not trying to get distracted, was like one of the criticism of the market timing historically has been like, oh, nothing survives the test of time. And like there's no one indicator, and we agree there's no one indicator that can tell you what the market's going to do. But we think if you combine a lot of them, and if you're smart about how you're combining them, you can generate a consistent edge over a long period of time. So as I think going back to your original question was, what are we seeing? Kind of not surprising anybody, we're seeing a lot of very bearish signals from any valuation metric we look at. And we're seeing some bearish or like warning signs flashing from just what we see as like the dispersion, if you will, the breadth of the market. We see a couple companies pulling away, almost in the bubble territory, and sort of the rest of the index kind of struggling to keep up. And so that's one of the warning signs that we see flashing. But on the other hand, we do see some bullish indicator from kind of the shorter term market moves, from volatility. We don't see a lot of, exuberance, some kind of unrealistic optimism. We see some positive signals from the yield curve and the term structure. So it's definitely like a little bit of a mixed bag. It's not all bad.
And my understanding, there's something like 30 or 40 of these indicators?
Yes, about 40 at any given time, and then the models can choose a subset of them to put weight on.
Have you added or removed any indicators, say in the past year? Like, can these change, or are they static?
They can change, and they will change. I would say, as opposed to saying remove, I would say maybe replaced. So just to give you one example on the valuation metrics, instead of looking at like cyclically adjusted dividend yields, we have switched to looking at it like an average dividend yield. We switched to looking at median dividend yield, kind of going back to like the breadth of the market and how the index isn't really like, it's getting really top heavy. So we're sort of adjusting some of these, and we've been adding a lot of new sentiment indicators. We're trying to refine the transformations of the indicator. So over the last year, we have been looking at many different ways how to like slice and dice the information, look at, different look backs, different transformations of indicators. We have added some new models themselves. So it's definitely evolving.
Well, Petra, excellent conversation this week. Really enjoyed this. A very interesting ETF with HTUS. I certainly wish you the best of luck moving forward. Thank you for joining me.
Thank you so much, Nate. Thanks for discussing this topic with us. We're always so excited to talk about research.
Well, thank you. That was Petra Bakosova, CEO of Hull Tactical and Portfolio Manager of HTUS. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I will be joined by Ben Johnson, Head of Client Solutions Asset Management at Morningstar, who is going to look back on the year in ETFs and look ahead to 2026. Always one of my favorite episodes. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.